Flagged versus independent hotels, and which hotel investment is right for you. And investing in hotels can produce exceptional cash flow and long term appreciation. But one of the first decisions that investors face is whether to purchase a flagged or branded hotel or an independent boutique type property. And the answer isn't simply which one earns more revenue. Well, it's going to also depend on your financing, operating costs, franchise requirements, market positioning, and your long term investment strategy. And as a commercial mortgage advisor with CommLoan, I help hotel investors secure financing for both flagged as well as independent hospitality assets across the country. And understanding the differences before making an offer can significantly improve your financing options as well as your investment returns. So, what is a flagged hotel? Well, a flagged hotel operates under a national or international hotel brand. So, you might know Marriott or Hilton or Hyatt or Holiday Inn or Best Western or Choice Hotels or Wyndham. And the owner operates independently but licenses the brand through a franchise agreement. And some benefits there include is you're going to have more national brand recognition and national name recognition, but you'll get corporate reservations and have loyalty programs with professional operating standards, and you'll usually have a higher average occupancy and greater lender confidence. So here's some advantages of flagged hotels. Easier financing. Many lenders prefer branded hotels because performance data is just more predictable. And some benefits often include higher loan proceeds and better interest rates and lower risk premiums, but also more lending options. Stronger occupancy, and guests trust recognizable brands, and this often translates into a higher occupancy in your building, but a better ADR or average daily rate, and more repeat customers, but also corporate travel demand. And there's operational support. So brands are going to provide marketing systems and reservation systems and technology and training and revenue management and national advertising. So let's look at some disadvantages of flagged hotels. And owning a franchise also means additional costs, and typical expenses could include franchise fees and marketing fees and reservation fees and required renovations or property improvement plans or PIPs and brand compliance. And all of these expenses can reduce your cash flow. So what is an independent hotel? Well, independent hotels are privately operated without a major franchise affiliation, and owners have complete operational control. And some examples there may include a boutique hotel or a historic hotel or a lifestyle hotel or a resort type property or a local destination hotel. So what are the advantages of independent hotels? Well, lower operating costs, no franchise fees, no royalty payments, and no mandatory renovations from a brand that you're a part of. But greater flexibility, and owners can set their own pricing and develop their own unique branding and adjust their amenities and target niche markets and also renovate on their own schedule and potential for higher profit margins as well. So without franchise fees, well-managed independent hotels can really outperform flag competitors in certain markets. So what are the challenges of independent hotels? Well, financing can sometimes be more difficult, and lenders will more closely evaluate historical occupancy and cash flow and the management's experience with hotels and the market demand and the online reputation and your local competition. And without brand recognition, lenders rely more heavily on operating history. So which hotel is going to produce your better returns? Well, the answer really depends on you and your investment objectives. But flagged hotels are often better for first-time hotel investors and conservative investors and institutional buyers with long-term hold strategies and investors who are just seeking easier financing. Whereas independent hotels may be better for experienced operators and value-add investors and boutique hospitality specialists in destination markets and investors comfortable with creating their own brand. But there's also financing considerations. Hotel financing differs from other commercial real estate, and lenders evaluate occupancy history and ADR and RevPAR, as well as your net operating income and your debt service coverage ratio, or DSCR. but also your brand affiliation and the property conditions and any franchise agreements and any property improvement plans or PIPs. And working with a commercial mortgage broker gives investors access to multiple hotel lending programs instead of relying on one single bank. And the final thoughts for the day are that neither flagged or independent hotels are universally better than the other as far as an investment. The right choice really depends on you and your experience, your investment strategy, the market conditions, the financing structure, and your operational capabilities. And at CommLoan, we help investors compare financing options from hundreds of commercial lenders to identify the loan program that best supports their investment strategy. And whether you're acquiring your first hotel or expanding an existing hospitality portfolio, financing should be part of your decision before you make an offer. And if you're ready to finance your next hotel investment, I can help. My name's Bill Rapp with the CommLoan Empower program. I'm a commercial mortgage advisor. You can call me at 281-222-0433. As well, I invite you to check out my website, billrapp.comloan.com. You can start a pricing quote there. You can also schedule a consultation with me so we can have a conversation about whatever you're facing. I appreciate you watching and have a good day.